The US government is shutting down again, and this time, it's different. Something is happening in the United States that most people barely notice, yet it quietly affects markets, jobs, inflation, global confidence, and your money. No tanks in the streets, no stock market crash headlines, yet. No emergency alerts on your phone, just a short news clip. A partial government shutdown, entering its second day. Most people shrug and think, this happens all the time. And that's exactly the problem, because government shutdowns are no longer rare accidents. They're becoming a structural feature of the system. And when a system stops functioning smoothly, capital starts asking dangerous questions. What a government shutdown really is and isn't. Let's start simple. A government shutdown happens when Congress fails to pass funding legislation. That means certain parts of the federal government legally cannot operate. Now here's what doesn't shut down. The military keeps operating. Social security checks usually keep flowing. Interest on US debt still gets paid. But here's what does shut down or slow dramatically. Federal agencies, regulatory departments, border and immigration processing, government contractors, federal workers sent home unpaid. In this case, the dispute centers around Department of Homeland Security funding. That matters more than people realize. Because DHS isn't just about borders, it touches trade flows, travel and logistics, security infrastructure, data systems, supply chains. When DHS funding becomes unstable, economic friction increases, and friction is the enemy of growth. Why markets don't panic? Immediately, but should pay attention? You might be wondering, if this is so serious, why isn't the market crashing? Because markets are forward-looking, not emotional. Investors have seen shutdowns before. They assume it will be temporary. Politicians will blink. A deal will be reached. So initially, markets do nothing. But behind the scenes, something else happens. Capital starts repricing risk, not dramatically, not loudly, quietly. Bond traders, institutional investors, and currency desks start asking, how reliable is US governance? How predictable is fiscal policy? How often will this happen going forward? And when uncertainty becomes frequent, it gets priced in permanently. That's when borrowing costs creep higher. That's when long-term confidence erodes. That's when temporary becomes systemic. The real economic damage happens off-camera. The biggest damage from shutdowns doesn't show up in headlines. It shows up in places you don't see. 1. Federal workers and contractors. Hundreds of thousands of workers are affected. Some get back pay later. Many contractors do not. That means missed rent, missed mortgage payments, reduced consumer spending, increased personal debt. Multiply that across regions where federal employment is a major employer. That's localized recessions, created artificially. 2. Small businesses get hit. First, government contractors are often small or medium-sized businesses. They still have to pay staff, pay suppliers, pay rent, pay interest, but revenue pauses. That's how shutdowns quietly kill small firms, even when the government later reopens. No bailout, no apology, no headlines, just closure. Shutdowns plus debt equal a dangerous combination. Here's where things get more serious. The US is running historic levels of debt. Debt works only if creditors trust the borrower, governance appears stable, political systems function predictably. Shutdowns signal the opposite. They tell the world, we can't even agree to keep the lights on. Now ask yourself, if you were lending trillions of dollars, would that inspire confidence? Bond markets. Watch this closely. Every shutdown reinforces the idea that fiscal discipline is absent, political polarization is structural, long-term planning is impossible. That pushes investors to demand higher yields. Higher yields, higher interest costs. Higher interest costs, larger deficits, more borrowing. It's a feedback loop, and feedback loops don't end gently. Why the dollar still holds, for now. You might be thinking, but the dollar is still strong. Yes, for now. Not because the system is healthy, but because there's no clean alternative yet. The dollar survives on inertia, global dependence, lack of substitutes. But every shutdown chips away at something critical: trust. And currencies don't collapse when people panic. They collapse when people quietly diversify. More gold, more bilateral trade, more local currency agreements, more non-dollar settlement systems. You don't see that on CNN. You see it in central bank balance sheets. Why this shutdown feels different? This isn't just about funding, it's about governability. The US political system is becoming more polarized, less functional, more performative, less solution-oriented. Shutdowns are no longer failures. They're weapons, used for leverage, used for headlines, used for positioning. And markets hate weaponized uncertainty. The global message being sent. Every government shutdown sends a message overseas, not to voters, to competitors. It tells them, the US is internally divided. Long-term commitments are fragile. Domestic stability can't be assumed. In a world of rising geopolitical competition, that matters, because economic power rests on stability, predictability, credibility. Shutdowns undermine all three, inflation's silent partner. Here's something most people miss. Shutdowns can be inflationary, even without stimulus. Why? Because supply chains slow, processing delays increase costs, regulatory approvals stall, insurance and risk premiums rise. Businesses don't absorb those costs, they pass them on. So even when inflation appears under control, shutdowns quietly push prices higher, especially in housing, healthcare, transportation, trade, the psychological shift. Perhaps the most dangerous impact is psychological. When people see repeated dysfunction, they adjust expectations. They stop believing. Government will protect them. Systems will function. Planning long-term is safe. That leads to short-term thinking, higher personal risk-taking, more debt dependence, less saving. That's how financial fragility spreads socially. What this means for ordinary people. Let's bring this home. If shutdowns continue becoming routine, expect more volatility, less job security, higher borrowing costs, weaker safety nets, greater reliance on personal resilience. This isn't about politics, it's about systems under strain, and strained systems eventually force adjustment, either orderly or chaotic. The bigger picture, nobody wants to say out loud. Government shutdowns are a symptom, not the disease. The disease is debt saturation, political fragmentation, monetary exhaustion, loss of institutional trust. Shutdowns simply expose the cracks, and cracks don't fix themselves. History shows us something uncomfortable. Great economies don't collapse in explosions. They erode. Through repeated dysfunction, normalized instability, quiet confidence loss. And one day, people look back and say, we should have taken those shutdowns more seriously. This shutdown may end tomorrow or next week, but the pattern won't. And patterns matter more than events. If you want to protect yourself in a world of unstable systems, you must understand the signals, not the slogans. Because when governments stop functioning smoothly, the burden always shifts downward to workers, to savers, to families, and eventually, to you. If this helped you see the bigger picture, subscribe, share, and stay alert. Because the most dangerous economic shifts are the ones that happen quietly. This is Felix. See you next time.